In last week's video, we talked about structured notes. In particular, we looked at a specific structured note example that would generate a 20% annual rate of return. Now, at a 20% annual rate of return, we clearly know what could go right with this note, which is generate a 20% annual rate of return. In today's video, I'm going to focus on risk, and I'm going to talk about the 5 things that you should be thinking about that could be risks inside of a structured note. And so the first risk that you should be thinking about is market risk, or the underlying investments. How do they perform? Because if they don't perform well or in line with how the note needs them to perform, your note will not do well. Your note will not perform. And so it's important that when these notes are getting built, that when you look at the underlying investments that they're linked to, that you're not against holding these investments in your portfolio, because when it's linked to the note, you essentially do own these underlying investments. So it's important to understand or have your advisor clearly articulate, why do we own these underliers? Do we like the current price, right? Do we like the diversification? Whatever it might be. You need to understand the underliers, because if they don't do well, your note will not perform as expected. Your second risk is going to be your issuer risk, or the credit risk of the bank. So keep in mind, this is a bond issued by a bank. If your bank goes bankrupt, for example, Lehman Brothers back in 2008, you become an unsecured creditor of that bank. And so you need to make sure that you have a comfort level with the bank that you're doing business with, that they are going to be in business. But that is a risk that you're taking, that if the bank goes bankrupt, you have a problem because you are a bondholder of that bank. Number 3 is liquidity risk. And so while some notes are shorter term, some notes are longer term, and the note we talked about last week, that was a 5-year note. So realistically, you might need your money back in less than 5 years. Now, the way that particular note that we discussed works is if the markets go positive, you are called out of that note. And so most of the time, it is a much shorter term note than 5 years. It might be 1, 2, 3 years, however long it takes for the markets to go positive. But with any investment, in particular with structured notes, if you own the note and it has not been called by the bank, you don't necessarily have an easy out. Now, you can sell it back to the bank if you have an agreed upon price, or you can sell it in the secondaries market. But you do not have a guarantee that you will be able to get the money that you put in back out of the note. It's going to be tied to how the underlying investments are doing. Number 4 is reinvestment risk. Now, this one might seem a little strange, but let's say this 20% structured note hypothetically gets called a year from today. And you look and you call your advisor and you say, hey, great, the note got called, we made our 20% rate of return, what do we do now? Well, the structured note market changes. The landscape shifts. Banks go in and out of the market and are willing to pay different terms based on what's happening with interest rates, volatility, etc. And you might earn your rate of return, be out of the note, and the new notes or your new investment options might not be as attractive. And so it's important to understand that you might have a 5-year note at a stated rate of return, but it doesn't guarantee you're going to get that rate of return every year you're in the note. It's until it gets called, and then when it does get called, the good news is you have liquidity if you want it. The bad news is you now have to figure out what you're going to do with those dollars and how you're going to get reallocated, and there is a possibility that the terms might not be as attractive as before. And number 5 is your opportunity cost. And so using the example from last week, the 20% rate of return, opportunity cost means, well, what else could you do with that money that you might have earned a better rate of return? And so maybe you might say, hey, I've got, a better investment option that's going to generate a higher rate of return than this note, in which case investing in a note or in any investment that's going to give you a lower rate of return has an opportunity cost for what else you could do with the money, right? You might be a business owner and say, I can put this capital into my business and generate a higher rate of return. You might have, just making up stuff here, really high interest rate debt at 29%, in which case if you're generating a lower rate of return, that is an opportunity cost. But keep in mind that if you are allocating to any investment, you have an opportunity cost of what else you could do with those dollars. And so whether it's invest in your business, invest in other investments, whatever it might be, you have the opportunity cost of underperforming if the investment that you allocate to doesn't do as well as whatever else you could have put that money in. And so again, those are your 5 important risks that you need to think about. 1, again, as a summary, is how do your underlying investments do? Incredibly important to understand how that's going to impact your returns. Number 2 is bank risk. Your bank needs to stay in business. Number 3 is liquidity risk. How do you get out of the note if you need the money before the terms are up? Number 4 is your reinvestment rate risk. So your note may get called after a certain period of time and you may not be able to reinvest it at that same high rate of return. And number 5 is opportunity cost risk. And so wherever you put your investment, the opportunity cost is whatever you could have done if you would have put that money elsewhere, the rate of return you could have gotten elsewhere. And so, like anything, with any investment, as I always say, you should know what you own and you should know why you own it. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.